Started. Bismillahirrahmanirrahim. Assalamu alaikum. Good evening, everybody. This is our second day. Yesterday, we started discussion on financial instrument, and we covered almost International Accounting Standard 32, and thereafter we started International Financial Reporting Standard 9. And at the end, we were discussing an important aspect of International Accounting Standard 32, but then time was over. So I'll be continuing from the same point where we reached at 7 p.m. yesterday. So before I start discussion, so please tell me, can you people hear me very clearly?
Good afternoon, said by Renata.
Renata, good afternoon.
Yes.
Can you people hear me?
Sanawala, sir.
Okay,
yes.
Okay. This way, I am reaching you people. Thank you very much for your feedback.
Sound clear today, Osama Jane.
Okay. Okay. Yesterday, we discussed compound instruments. What we discussed that what are the compound instruments and how can we treat that. Yesterday we discussed if an entity issues a financial instrument that is hybrid, for example, convertible debentures, then the holder of such instrument has the option either to convert it into fixed number of equity shares or cash at the date of redemption. And International Accounting Standard 32 requires that hybrid instrument should be recorded by separating the debt and equity element. And then yesterday we discussed how can we differentiate, how can we separate the debt and equity element, and we learned the step number 1 was determine the future cash flows attached to the compound instrument, assuming cash will be paid on redemption, actual cash flows. And this was step number 1. And then step number 2, which we learned yesterday, discount future cash flows using market rate or effective rate of interest. The debt element will be the sum of discounted balances. So these are the 2 steps which we discussed. So next, we shall discuss if there is an issue cost, because yesterday we discussed 2 illustrations in order to demonstrate that how can you separate debt and equity element. Today, if there is an issue cost, because that issue cost relates to both debt element and the equity element, what will be the method for that? So we will do this with the help of this small illustration, which I tried to write on Word document yesterday, but now the whole scenario is in front of you. I shall be reading it with you, and then of course we shall be discussing the concept of issue cost and how can we treat that issue cost with the help of this illustration. See, the illustration is on 1st July 2011, 2 million convertible debentures of rupees 100 each were issued. Each debenture is convertible into 25 ordinary shares of rupees 10 each on 30th June 2014. Interest is payable annually in arrears at the rate of 8% per annum. On the date of issue, market interest rate for similar debt without conversion option was 11% per annum. However, on account of expenditure of rupees 4 million incurred on issuance of shares, the effective interest rate increased to 11.8%. Okay. prepare journal entries for the year ended. First of all, what you will do, you will simply calculate the debt and the equity element, ignoring any issue cost. So if we just use and these slides are uploaded on the GoToWebinar. So please download those slides so that this this example is in front of you while we discuss its solution and its answer. Okay, we can have from here one empty Word document. Okay, see 2 million debentures and rupees 100 each. So this means, in fact, we collected 200 million. 200 million. Okay. So the nominal interest rate is 8%. So this will give us, Khayam, can you please give me the calculator if we have one? This will give us the cash outflow. So step number one, we know that we shall determine the actual cash outflow. See, if we write here like year one, year 2, year 3, and then year, yes, 3 years. And cash outflows for each year is basically in first year, this is the interest. And then the interest, and then at the last year, this is interest plus the principal. So at the end of the year, this figure should be in million. Thank you very much. Okay. So 200 into 0.8, this will give us 16. So we have here 16 outflow, and then 16 outflow, and in third year 200 plus 16. These are the cash outflows related to this instrument. Then we shall be applying the discount factor, which is market or effective rate, and that is 11% as given in the question. So first year the factor will be 1.11. Second year the factor will be 1.11 raised to power 2, and the third year factor will be 1.11 raised to power 3. I used 1, 2, 3 year for convenience, but in fact from question you people know that this is in fact the date 30th June. This is the 30th June. 30th June 2012, and this is again 30th June 2013, and this is 30th June 2014. Okay, now by multiplying all these figures, so we shall be able to calculate like the present value over here. So here will come the present value. So when we total these present values, so this will come to 185.34. So this is total debt element. And we know that the balancing figure out of 200 million will be the equity element, which will be 14.66 million. So this is equity element. Equity element. Balancing figure. Okay. Now, before passing the double entry initially, we shall allocate the issue cost to these two elements. For example, here we have liability element, debt element, and debt that we calculated like 185.34, and then there is equity element, and then there is equity element 14.66. This is equity element, and of course we know that the total is 200. These are basically the proceeds before any issue cost. Now, what is issue cost? Issue cost, we know from the example, is basically 4 million. We shall divide this 4 million between equity and debt in a pro rata basis. For example, how can we calculate? We can calculate like for debt, this will be, if I mention over here 1, so I can show my calculation 1, and if I mention over here, like instead of 1, because this A, and if I mention over here B. So what is A in fact? A is equal to 4 million into 185 divided by 200. This will give us some figure. This will give us 185.34 divided by 200 into 4. This will give us 3.71. I am rounding this figure. 3.71. And B can be calculated similarly. This is basically, we are bifurcating it on a pro rata basis. We are bifurcating 4 million on a pro rata basis. 4 million into 14.66 divided by 200. So this will give us how much? 0.29. Okay, we'll keep it till this point. Okay, so this means 3.71 will be allocated to the debt, and 0.29 will be allocated to the equity. So this way, we can see that. So this 196, and this will become
the other one
14 point, and this one?
This one is 181.63.
181.63, okay, and 37. So this way you can allocate the issue cost. Now, what will be the double entry for this? Of course, the double entry will be debit cash, which is 200 million minus 4. So 196 million cash debit. Credit debt element, or whatever name you can use, like debentures or whatever. account as we calculated on the top. So this is 181.63 million, and credit equity element 14.37 million. 14.37 million. So this is the double entry for recording of hybrid instrument. Yesterday we discussed this entry, but today with the effect of issue cost. So if you have any question, if you are not clear so far as this calculation is concerned, so please feel free to ask any question. Okay, so fine, this means it is clear. We can move to the next. So this was the example which we discussed. Incurred on the, just make a small correction over here. You all people are, so instead of shares, debentures, in fact, these debentures. This is the issue cost of these debentures. So this is a small correction, please note it. Then this is another small example. Aaron issued 1 million convertible bonds on 1st June 2006. Aaron. Okay. So the bonds had a term of 3 years and were issued with a total fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum, and bonds without the conversion option attracted an interest rate of 6%. Attracted an interest rate of 6% per annum. Okay, interest rate of 9% per annum on 1st June 2006. The company incurred issue cost of 1 million. If the investor did not convert to shares, they would have been redeemed at par. At maturity, all of the bonds were converted into 25 million ordinary shares of $1 of iron. No bonds could be converted before that date. The directors are uncertain how the bonds should have been accounted for up to the date of the conversion on 31st May 2009, and have been told that the impact of the issue cost is to increase the effective interest rate to 9.38%. So prepare the journal entries at year end to record the above transactions. Okay, so first of all, step number 1. So these handouts are in front of you. We can use like this document. Okay. See again, 1 million convertible bonds, and each bond has a face value of rupees 100 million, $100. So in total we collected $100 million. This is the amount we collected, and we know that the step number 1 is to determine the cash flows. The cash flows related to this transactions. Cash flow related to this transaction. Okay, the cash flow related to this transaction are very simple. These are basically the interest interest on the face value. And if we just look at our example, so you can see that here the interest is, let me make it on one side. So here you can see that this is the nominal interest rate, which is 6%. And this is the face value, par value of the convertible. And this was issued on 1st June. And for 3 years. 3 years mean 2007, 2008, 2009. 3 years. 3 years. So it's so what will be the value for this? This will become like step number 1. If we apply 6%, so this will give us here 1, 2, 3. Cash flows like if we apply the 6%, this will give us like 6 million. All figures are in million, then 6 million, then of course 106 million. 106 million. And what is the discount rate which we can use over here? What is the discount rate which we can use over here? Okay. This is the discount rate which we can use over here. This is basically, let me open it in front of me so that figures are in front of me, because on the right hand side, when I start solving, the screen is not in front of me. Okay, so now this is in front of me. Okay, 106 in the last year, and our discount factor will be based on effective interest rate, and in this case, effective interest rate is as given here, 9%. So 1.09. Second year, 1.09 raised to power 2. And third year, 1.09 raised to power 3. So this will give us the
5.50
present value of each year. I am not going to mention over here because this is quite straightforward, because we shall be multiplying 6 with this, and 106 with this. This will give us some value, but the total of total value will become 92.407. You can check it. So this is basically the total debt element. This is basically the total debt. And equity element is the balancing figure. Equity element is the balancing figure, in fact. Balancing figure. And that is the difference of,
yes, 92.405.
okay, fine, thank you very much. And this will become 7.593. Of course, all figures are in million. So this is basically the equity element. So this is something normal. Next, we shall be incorporating here. We shall be incorporating here the issue cost. Shall incorporate here issue cost. Okay. So now again, we know we have here debt element, equity element, debt element, equity element. Debt element is 92.407 million, and this is 7.593 million, and so this will give us total 100 million. So these were the proceeds before the issue cost, and the issue cost is basically 1 million. We shall be allocating this 1 million on a pro rata basis. So the same way as we did earlier, we shall be calculating, like if I mention over here, like this is A, this is B. So A will be equal to 1 million into 92.407 divided by 100. And similarly, B will be 1 million, which is issue cost, into pro rata 7.593, and the amount is quite obvious. 100 is, in fact, this is the 100, the total of these two. So this will give us 9.2407, and this will give us point. Okay, we make it 76. So this way, so again here, this is the minus. So this will be the figure, and this will give us 91 point because it was 100, so it should be 0.92. There is a small mistake here. 0.92. 0.92. So this will become 91.483 approximately, and this will become 7.517. Can you please calculate it? There may be a small rounding difference. So the debit will be cash in this case, and which is 100 minus 1, 99, and credit will be debt element, which is 91.483 million, and credit. There may be small rounding difference, so please ignore that. 7.51799, and then 9, and this will give us 98, and then okay, fine, it looks fine. So this is the empty. Now subsequently, this will be like finance cost will be calculated using 9.38%. This is basically the effective interest rate after taking into account the issue cost. See, you might have seen in the example that there are two basically effective interest rate. One without the effect of without the effect of issue cost, and this is with the effect of the issue cost. Subsequently, when you will be this debt element, when you subsequently treating it, you will be using 9.38%. So I hope this was the concept from International Accounting Standard 32. So its treatment is clear. Okay. Now we can move.
Yes.
Now we can move to International Financial Reporting Standard 9. We discussed financial liability portion of IFRS 9 yesterday. Today we shall start discussion with financial asset. Then we shall discuss subsequently impairment of those financial assets. So if we have time, we may start hedging today as well. Okay. Financial instruments, IFRS 9, remaining portion. See, financial asset, the accounting treatment of financial asset. See, we know that financial assets could be like debt instrument or debt asset, or it could be equity asset. If you have invested, if you have extended a loan to another party, then this is your asset because this is your investment. But this financial asset can be termed as debt asset. Other examples are investment in bonds. Your trade receivable is basically the debt of the other party. So that's why these financial asset can be termed as debt asset. On the other hand, if you have invested in the shares of another company, this is also your asset, this is your investment, but this can be termed as equity asset. The objective of bifurcating financial asset into these two categories is there will be a difference of accounting treatment so far as the debt asset is concerned and the equity asset is concerned. So we need to refresh accounting treatment of both separately. Okay, first of all, we talk about debt asset. Debt asset where you have invested in the bonds of another company. Account receivable, where you have invested in the debentures of another company. So this is your debt asset. On recognition, financial assets that are debt asset are classified at either amortized cost or fair value through other comprehensive income or fair value through profit or loss. If we recall yesterday's discussion, we learned about financial liability that amortized cost is a default position for the financial liability. But if you want to keep financial liability at fair value through profit or loss, it has to meet certain conditions. Like yesterday we discussed that, number one, if it is held for trading. Number two, you want to avoid accounting mismatch. You want to give a more appropriate presentation of that financial liability. Otherwise, you will be measuring your financial liability at amortized cost. This means amortized cost is the default position. Similarly here, fair value through profit or loss is the default position. There should be some conditions. There are some conditions which must be met if you want to classify your debt asset using amortized cost or fair value through other comprehensive. There are conditions which must be there. In other cases, simply go for fair value through profit or loss. Okay. Let's discuss it one by one. Like a financial asset, that is a debt instrument, will be subsequently accounted for using amortized cost if it meets two simple tests. These two tests are the business model test and the cash flow test. If your financial asset satisfies these two tests, then that financial asset will be measured at amortized cost. What are these tests? The business model test is met where the purpose is to hold the asset to collect the contractual cash flows rather than to sell it prior to maturity to realize its fair value changes. The cash flow test will be met when the contractual terms of the asset give rise on specified dates to cash flows that are solely receipts of either the principal or interest. We shall be discussing this model with the help of a number of examples. And a financial asset must be classified and measured at fair value through other comprehensive income if it meets both of the following criteria. Number one, the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. The contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. If we just compare it with the last slide, we can see that what is the difference between these two. So there is a contractual cash flows, and second one is the same, but in the second slide you can see that in addition to the contractual cash flows, if there is objective is to sell the financial assets as well, if both objectives are there, then this debt asset is classified at fair value through other comprehensive income. Okay. And all other debt assets must be measured at fair value through profit or loss. So this is the default position. For financial liability, the default position is amortized cost. And for financial asset, mean debt asset, the default position is fair value through profit and loss. Okay. Now there is an exception, and the same exception applies in case of financial liability as well. See, even if an instrument meets the above criteria for measurement at amortized cost or fair value through other comprehensive income, IFRS 9 allows such financial assets to be designated at initial recognition as being measured at fair value through profit or loss if a recognition or measurement inconsistency, mean accounting mismatch, would otherwise arise from measuring assets or liability or recognizing the gains and losses on them on different bases. Like you have a financial asset, which is a debt asset, and you know that the conditions required to classify, to measure it at fair value through other comprehensive income or to measure it at amortized cost are being met. But this will result in the accounting mismatch. In that case, instead of meeting those conditions, you will be measuring that financial asset at fair value through profit or loss in order to avoid that accounting mismatch. For example, if an entity holds a financial asset that is debt and that carries a fixed rate of interest, but is then hedged with an interest rate swap that swaps the fixed rates for floating rates. The interest rate swap is a financial instrument that would be held at fair value through profit and loss. And so accordingly, the financial asset classified as debt also needs to be at fair value through profit or loss to ensure that the gains and losses arising from both instruments are naturally paired in the income and thus reflect the substance of the hedge. If the financial asset classified as debt was accounted for at amortized cost, then this would create the accounting mismatch. This means in hedging relationship, the hedged item and the hedging instrument. If like here in this case, interest rate swap, you entered into a interest rate swap that is basically the hedging instrument, and the hedged item is those fixed interest income. So because because interest rate swap is being measured at fair value through profit or loss, so the financial asset will also be measured at fair value through profit or loss, even though that financial asset meets the conditions required to be treated it as to be measured it as fair value through other comprehensive income or fair value or at amortized cost. So this is basically the concept which we discussed yesterday as well. Then is initial measurement and subsequent measurement. See, initial measurement, you will measure financial asset, which is debt asset, at fair value if subsequently it will be measured at fair value through profit or loss. And fair value plus issue cost. In case of financial liability, this was fair value less issue cost. But in case of asset, fair value plus issue cost, if it will be subsequently measured at amortized cost or fair value through other comprehensive. See, financial instruments are initially measured at the transaction price, that is the fair value of the consideration given. An exception is where part of the consideration given is for something other than the financial asset. In this case, the financial asset is initially measured at fair value, evidenced by a quoted price in an active market for an identical asset, or based on a valuation technique that uses or data from observable markets. The difference between the fair value at initial recognition and the transaction price is recognized as a gain or loss. I repeat it again. See, it is mentioned over here, like on initial measurement, you will be recognizing your financial asset, which is a debt asset, at fair value. What is fair value? Fair value is basically the consideration given. But what is the exception? Exception is like if consideration given is something other than the financial asset. Other than the financial asset, anything other than the cash or other financial asset. In that case, you will be calculating the fair value of that financial asset using the criteria given in the IFRS 13. What is that? That is, fair value should be based preferably should be based on open market value, active market of the identical asset, or based on the valuation techniques that uses or data from the observable markets. These are the guidelines given by the IFRS 13. Yes. Normally, though these transactions are at arm's length, but now the more objective wording has been devised by the new standard. So that's why they do not use arm's length. Another exception is trade receivable. An entity shall measure the trade receivable at their transaction price as defined in IFRS 15. So there are two exceptions. Otherwise, your fair value will be the consideration given. One exception, if consideration is other than, you have given as a consideration something which is not a financial asset, then the fair value at initial recognition will be determined by using the criteria given in IFRS 30. And the second exception is your trade receivables, because your trade receivable is also a financial asset, and this is a debt asset, because for the other party this is a debt. So this is your debt asset. Its value will be determined using the criteria given in the IFRS 50. Subsequently, of course, you will be applying IFRS 9. I hope it is clear. Now we can move further. Okay. Now we have a small illustration. Whenever we have any question, because I am moving.
I am surprised myself that so far we have.
No, actually we are moving very slowly. We are moving very slowly, and I suppose people are understanding what we are saying. Yes, and rather they are refreshing it. But this will only be confirmed through the pop-up questions. So we shall of course yes, we shall be popping up questions from time to time. This will give us the idea whether we are reaching you people or not. But anyway, so far we discussed theory, that is the basics underlying any numerical working. An entity, ABC company, ABC Limited, purchased a 5-year bond on 1st January 2010 at a cost of 5 million with annual interest of 5%, which is also the effective rate payable on 31st December annually. At the reporting date of 31st December 2010, interest has been received as expected, and the market rate of interest is now 6%. Account for the financial asset at 31st December 2010 on the basis that it is classified as fair value through profit or loss, and if it is classified to be measured at amortized cost on the assumption that it passes the necessary test and has been properly designated at initial recognition. Okay, so this is a 5-year bond, and we are only required to just comment for the first year. So the same approach which we discussed yesterday for financial liability will be used. Okay, first of all, if it is classified at fair value through other comprehensive income, it is classified. Okay. So this was issued on 1st January. So if we use Word doc here, so we are going to discuss illustration related to financial asset. Okay, when classified at fair value through profit or loss. Fair value through profit or loss. See, first year, like our first year is basically year ended 31st December 2010. So what is the opening balance? Okay, opening balance is basically opening balance of this asset is basically 5 million. You can look at the illustration. 5 million, nominal interest rate is 5% and effective interest rate is 5%. Okay, fine. But we know that finance income, which will be credited to the profit or loss, will be calculated using the effective interest rate. So this will give us, when we multiply 5% with the 5 million, so this will give us 0.25 million. Okay, and cash received will be calculated by multiplying the coupon rate of interest with the face value, and that is also 5 million. So again, this will give us 0.25 million. So this is 25 million. Okay. So the closing balance will become again 5 million. Now what happened? Because we are classifying this financial asset at fair value through profit or loss, and information is given in the question that there is a change in the effective interest rate. At 31st December 2010, the effective interest rate is now 6%. So we shall be calculating the fair value of this financial asset at 31st December 2010, and we shall be calculating the fair value, and this will go to statement of financial position. And the difference, like if we treat it as A and if we treat it as B, the difference will go to profit and loss. As we learned yesterday, how can we calculate the fair value at 31st December 2010? So after this date, the next year is 2011. This is the first year after this date, and then 2012, and then 2013, and then 2014. And the cash inflows will be 0.25, and in the fourth year, at the end of fourth year, 5 million plus 0.25. So this will give us 5.25 million. The discount factor which we will use is basically 6%. The new effective interest rate. Discount factor will be used 6%. So for first year, this will be the factor. And for second year, this will be the factor. For third year, this will be the factor, and this is the factor for fourth year. This will give us some value like 0.2358 for second year, 222.5, for third year 0.2099, and for fourth year 4.1585. So when we total all these amounts, this will give us 4.8267. This is the fair value. This is the fair value which should be here. 4.8267. Therefore, at the reporting date, mean on 31st December 2010, the financial asset will be stated at the fair value of 4.8267. With the fall in fair value amounting to, what is the difference between? This is a fall of the fair value, 0.1733. This is the difference, isn't it? Yeah? 0.1733. And this will be taken to the, as we have discussed, to the profit and loss account for the year. Interest received will be taken to profit and loss for the year amounting to 0.25 million. So this will be the two. If you just recall, this is exactly the same as we did in case of financial liability. The only difference is there were cash outflows because of liability, and here cash inflows. There you are paying interest. Here you are receiving interest. There you are paying making capital repayments. Here you are receiving the capital at the end of the life of this financial asset. Otherwise, determination of fair value is same. Like we simply see from the date when we want to determine the fair value of financial asset, what are the actual cash flows, and we discount those actual cash flows using the effective interest rate prevailing at the date of the determination of the fair value. Here we were determining the fair value on 31st December 2010. So at that date, 6% was the effective interest rate. So this will give us the fair value of your financial asset at 31st December 2010. But the value before the determination of this fair value is basically 5 million. The carrying value of the financial asset is 5 million, and this is the fair value. The difference will be credited to the, no, here it will be debited because fair value is decreasing. This will be debited to the profit and loss account. So this figure will appear in the statement of financial position in two portions, one for the long-term in the long-term assets and other in the current assets, and this figure will go as a finance income in the profit and loss account. Okay, if the same asset is being measured at amortized cost, then what will be the situation? Okay, so the B is, if this financial asset being measured at amortized cost. This requires that the fair value of the bond is measured based upon expected future cash flows discounted at the original effective rate of interest. This will continue to be at 5 million as the, see, here there will be no difference, because as we did in case of financial liability, because effective interest rate at inception is the same, 5%. Nominal interest rate is 5%. So this will remain the same, like 5 million opening, 5 million closing, and we shall not be calculating any fair value. So this will remain the same, 5 million, 5 million. At the end of at the end of last year, this 5 million will be repaid. So this will become 0. So in case of amortized cost, simple, your value will remain at 5 million. Even you can test it, like, because under amortized cost, you use the same effective interest rate which was prevailing at the date of inception of this firm. So when you will discount future cash flows on 31st December 2010 by applying the 5%, this will give you the 5 million. So this is the second part of this illustration. Okay. Equity assets, those financial assets which are equity assets. In case of equity asset, initially you will be measuring it at fair value. If subsequently it will be measured at fair value through profit and loss. And fair value plus issue cost if it will be subsequently measured at fair value at through other comprehensive. So this is the principle for equity asset. But if you want to measure it subsequently at fair value through other comprehensive income, this selection will be made at the inception, and you cannot revoke that treatment. You will have to follow that treatment. You cannot change that subsequently. Because after some slide we shall be discussing like where you can change classification subsequently and where you cannot. But this is one example where once you classified a financial asset, which is an equity asset, at fair value through other comprehensive income, subsequently you cannot change this classification. Okay, next is business model test. Business model test, we can look at the examples and some illustrations of business model test, which will give us an idea that what is this, basically the business model test. See, IFRS 9 introduces a business model test that requires an entity to assess whether its business objective for a debt instrument is to collect the contractual cash flows of the instrument as opposed to realizing its fair value change from sale prior to its contractual maturity. See, note that the assessment is based on how management personnel actually manage the business, rather than management intentions for specific financial asset. This is basically depends on your assessment will be based on your actual behavior, management actual behavior, how they actually manage the business, not on their intention. An entity may have more than one business model for managing its financial assets, and the classification need not be determined at the reporting entity level. For example, it may have one portfolio of investments that it manages with the objective of collecting contractual cash flows, and another portfolio of investments held with the objective of trading to realize changes in fair value. And it would be appropriate for entities like these to carry out the assessment for classification purpose at portfolio level rather than at entity level. Treat each portfolio separately. If you are holding a portfolio to collect the contractual cash flows, so then this those financial assets will be measured at the amortized cost. Okay. Although the objective of an entity business model may be to hold financial asset in order to collect contractual cash flows, the entity need not hold all of those assets until maturity. Thus, an entity business model can be to hold financial asset to collect the contractual cash flows even when sales of financial asset occur. Let's have a look at example number 1. Example number 1 is where is our example? Example is basically, yes. Okay, this is example which is in front of you. A company holds investments to collect their contractual cash flows, but would sell an investment in particular circumstances, perhaps to fund capital expenditure or because the credit rating of the instrument falls below that required by a company investment policy. See here, although company A may consider, among other information, the financial asset fair value from a liquidity perspective, that is the cash amount that would be realized if a company needs to sell asset. A company objective is to hold the financial assets and collect the contractual cash flows. So this is the objective, in fact. To collect the contractual cash flows. Hold the asset and to collect the contractual cash flows. What are those contractual cash flows? Of course, here we are discussing basically financial assets that are debt asset. And those are in fact interest. Contractual cash flows are basically interest and or principal. Principal. So that's why a company can apply amortized cost. Why? Because if sale is infrequent, even then a company can apply can measure the financial asset at amortized cost. Mean there will be two conditions. Sales of these assets is infrequent, rare, and the other is frequent. See, the objective of a company is to hold the financial asset and collect the contractual cash flows. Some sales would not contradict that objective for whatever reason. Some sale would not contradict that object. That object will be considered as remain intact. That the objective of the company is to collect the contractual cash flows. But if sales become frequent, then a company might be required to reconsider whether the sales were consistent with an objective of collecting contractual cash flows. Of course, in that case, because the actual management of that portfolio is changed, so this objective will no longer be there. If this objective is no longer be there, this means you cannot measure your debt asset at amortized cost. Then you will have to measure it in other ways. Okay, I hope this example 1 is clear. If you have any questions, so please keep on asking along while we are discussing these examples, because these examples are taken from the application guidance of the IFRS 9. But if you are clear, this is a good thing. But then we will take the leverage of this understanding, and we shall be incorporating these concepts into the pop-up question. Okay. Next is okay. This means the assessment is not made at an individual financial instrument level. The assessment is based on how key management personnel actually manage the business. So this is the point which we learned from this business model test. Contractual cash flows, as I mentioned earlier, these are basically only principal or interest on or interest on principal, and interest could be entirely fixed, floating, a combination of fixed and floating, no matter. Interest can be in any form, but that will be taken as an interest. Contractual cash flows could be principal only in case of zero coupon bonds. Principal only where you buy a bond at a heavy discount, and then it is redeemed at par value. So there the interest element is built into the difference of the consideration paid and the amount you receive. So there the only cash flow will be the principal. So that will be taken as a contractual cash flows. See, for example, a variable rate instrument with a stated maturity date that permits the borrower to choose to pay 3 months LIBOR for a 3-month term or a 1-month LIBOR for a 1-month term. Second example could be a fixed term market interest rate bond where the variable interest is capped. A fixed term bond where the payments of the principal and the interest are linked to an unleveraged inflation index of currency in which the instrument is issued. See, my question is, no, this we can make a pop-up question. So in order to wake you people up, see what we are discussing. We are discussing like you will be measuring your financial asset, which is debt asset, at amortized cost if it fulfills the criteria of fulfill the business model test and the contractual cash flows test. The pop-up question is, please.
Yes.
The question is a convertible bond is the convertible bond satisfied the contractual cash flows test? So you people have like 2 minutes, think on it, and come up with
the options.
Yes, option, of course, yes, and the second option is no.
Okay. So I'm going to pop this question now. It has been popped up. Wake up all attendees. As a pop-up question is there, you have to participate in this.
Please wake up and answer this question. This will give me the idea that Very simple.
Seconds left now. So far, 30% people have voted out of around 478 engines.
Please wake up so that I could get good idea that
Okay, so we have left with 5 seconds now. I'm going to close this poll in a bit, so you have to submit your answer right away. Okay, I'm going to close it now. Thank you, everyone. So we have 70% people saying yes, while 30% people saying no.
30% people are correct. 30% people are correct. See, this is the second criteria. This is the second criteria, and what is that? Contractual cash flows should be principal, only principal, or and it could be only principal or it could be interest plus principals plus principal. Here you can see that in case of convertible, the inclusion of conversion option failed contractual cash flows criteria. See, because there is an option that the holder of convertible instrument can convert it into equity instrument. So this means there are interest payments, and instead of getting principal in cash, you can get the shares issued. So because of this, convertible bonds do not satisfy contractual cash flows. So that's why it does not fulfill the criteria. Contractual cash flow test is failed. See, the requirement of IFRS 9 to assess the contractual cash flow characteristics of a financial asset is based on the concept that only instruments with contractual cash flows of principal and interest on principal may qualify for amortized cost measurement. By interest, IFRS 9 means consideration for the time value of money and the credit risk associated with the principal outstanding during a particular period of time. Because of the inclusion of the conversion option, which is not deemed to represent payments of principal and interest. So that's why 30% people are correct. Okay, this was a wake-up call. Okay, next is business model test, collecting the contractual cash flows and selling financial assets. Collecting the contractual cash flows and selling financial assets. If this test is satisfied, then you are required to measure your asset at fair value through other comprehensive income. Okay, let's discuss with the help of example 4. Example 4, yes, example 4. Here is example 4. See, this example is basically it should be in front of me as well. See, D company expects to incur capital expenditure in a few years' time. D company invests its excess cash in short and long-term financial assets so that it can fund the expenditure when the need arises. Many of the financial assets have contractual lives that exceed D company's anticipated investment period. D company will hold financial assets to collect the contractual cash flows, and when an opportunity arises, it will sell financial assets to reinvest the cash in financial assets with a higher return. The remuneration of the managers responsible for the portfolio is based on the overall return generated by the portfolio. So this is an example of business model where both collecting contractual cash flows and selling financial asset is being achieved. See, the objective in this example of D company is achieved by both collecting contractual cash flows and selling financial asset. D company decides on an ongoing basis whether collecting contractual cash flows or selling financial asset will maximize the return on the portfolio until the need arises for the invested cash. So this is the example where this criteria is being met. Okay, listen carefully, and you are required to answer again in yes or no. Okay, this time we shall not be popping up the question. You can answer, you can mention your answer in the comment box. See, listen carefully. E company expects to pay a cash outflow in 10 years to fund capital expenditure and invests excess cash in short-term financial assets. When the investments mature, E company reinvests the cash in new short-term financial assets. E company maintains this strategy until the funds are needed, at which time E company uses the proceeds from the maturing financial assets to fund the capital expenditure. Only sales that are insignificant in value occur before maturity, unless there is an increase in credit risk. My question is, how is the business model of E company achieved under IFRS 9? Okay, make it simple. Is the business model under IFRS 9 is being achieved? Listen the small scenario carefully. The small scenario is E company expects to pay a cash outflow in 10 years to fund capital expenditures and invest excess cash in short-term financial assets. When the investments mature, E company reinvests the cash in new short-term financial assets. E company maintains this strategy until the funds are needed, at which time E company uses the proceeds from the maturing financial assets to fund the capital expenditure. Only sales that are insignificant in value occur before maturity, unless there is an increase in credit risk. Is the business model is achieved under IFRS 9? Please answer in yes or no. Okay, you have like 30 seconds to answer this question. Okay, whatever you answer, basically if we just look at the scenario, we will find that the objective of the E company is to hold the financial assets to collect contractual cash flows. Selling financial asset is only incidental to E company's business model. So this was the situation in case of E company business model. Okay, now example number 5. F bank holds financial assets to meet its everyday liquidity needs. The bank actively manages the return on the portfolio in order to minimize the cost of managing those liquidity needs. That return consists of collecting contractual payments as well as gains and losses from the sale of financial assets. To this end, F Bank holds financial assets to collect contractual cash flows and sells financial assets to reinvest in higher yielding financial assets or to better match the duration of its liability. In the past, this strategy has resulted in frequent sales activity, and such sales have significant in value. This activity is expected to continue in the future. So the objective in this case is to maximize the return on the portfolio to meet the everyday liquidity needs. And F Bank achieves that objective by both collecting contractual cash flows and selling financial assets. In other words, both collecting contractual cash flows and selling financial assets are integral to achieving the business model's objectives. So this was, in fact, some of the examples related to the business model test. Okay, now comes to the reclassification. Financial liability, you cannot reclassify, not permitted. Financial asset, equity instrument, not permitted. You cannot reclassify. And then is basically financial asset, debt instrument. When an entity changes its business model for managing financial asset, then you can change its classification. This is the summary of the reclassification. Now we shall be having a short break. Thereafter, we shall be discussing very important area, impairment of financial assets. Impairment of financial assets. So we can have a short break. And if you have any question related to the area discussed so far, you can write your question during this short break. And after the break, before moving to another important area of impairment of financial asset, I would like to answer to your question if there are any.
Our trainer will get back to you in a short while. In the meantime, you guys have been requested to kindly submit your question. So far, we have only received one question from Fateh Fakhri. So I request you all to please submit your question so that he will be quickly answering your questions after the break. Thank you, everyone.
Okay, welcome back. Uh, Impairment of financial asset. Impairment of financial asset is our next area. So we have questions here. So can you please read those questions?
Usman Yusuf saying, kindly explain debt instruments with example where business model test and contractual test does not fulfills. Debt instruments with example where business model and contractual test does not fulfills.
See, contractual cash flow test is not fulfilled in case of convertible bonds, as I mentioned earlier. So convertible bond is an example where contractual cash flow test is not being fulfilled. Next.
Okay, Fateh Fakhri asking, would you please clarify why the issue costs are not added to the fair value of debt asset when it is subsequently remeasured at fair value through profit and loss?
See, because your policy is to keep that asset at fair value through profit or loss. So any issue cost will become the expense of that particular period in which you initially recognize your financial asset, which is a debt asset. Because in case of amortized cost, if you just recall the definition of the amortized cost, all cash flows discounted using the effective interest rate will become the part of the amortized cost. So that's why, and in case of other comprehensive income, so this issue cost will be expensed out. This issue cost will become the part of the fair value of the asset.
Okay, we have
Okay.
questions.
Okay. Next is impairment of financial assets. See, impairment of financial assets under IFRS 9, the same impairment model applies to the following: financial assets measured at amortized cost, financial assets mandatorily measured at fair value through other comprehensive income, loan commitments, financial guarantee contracts, lease receivables within the scope of IFRS 16, and contract assets within the scope of IFRS 15, revenue from contract with customers, that is rights to consideration following transfer of goods or services. So the same model will apply to all these financial assets. So what was the old approach, in fact? If you just look at the old approach was an entity, say ABC Limited purchased a 5-year bond on 1st January 2010 at a cost of 5 million with annual interest of 5%, which is also the effective rate payable on 31st December annually. If in early 2011 it was identified the bond issuer was beginning to experience financial difficulties and there was doubt regarding full recovery of the amounts due to ABC Limited, an impairment review would be required. The expected future cash flows now expected by ABC Limited from the bond issuer are as follows: 31st December 2011, 0.2 million. 31st December 2012, 0.2 million. 31st December 2013, 0.2 million. And 31st December 2014, 0.2 million plus 4.4 million. Calculate the extent of impairment of the financial asset to be included in the financial statement of ABC Limited for the year ending 31st December 2011. See here, you can see that these are basically the expected cash flows at the date subsequent to the date when we realized that, when we feel that there are indications of impairment. So we calculated the cash flows, we estimated the cash flows attached with this instrument. And the old approach is simple, simply discount these future cash flows by using the original effective interest rate, which was 5%. This will give you the present value of the amount, of the recoverable amount, you can say that. So in this case, when you will multiply this with the discount factor, which is like 1 divided by 1.05, and this with 1.05 raised to power 2, and multiply this with 1 divided by 1.05 raised to power 3, and this figure with 1.05 raised to power 4. So this will give you some value, and this will become your recoverable amount. This will become your recoverable amount. So the difference between the difference between the difference between 4.329 and the 5 million will become your impairment loss. This is the impairment loss. And this impairment loss will be charged to this financial asset. This is your impairment loss. This is the old approach. This is the old approach. Old approach basically depends on the trigger, on the indication of impairment and incurred credit losses model. So this is the old approach. Okay. So this old approach basically based on these two factors. It assumed that all loans would be repaid. There was until evident to the contrary. That is until the occurrence of an event that triggers an impairment indicator. Only at this point was the impaired loan written down to a lower value. The global financial crisis led to criticism of this approach for many reasons, including that it leads to an overstatement of investment revenue in the periods prior to the occurrence of a loss event and produces deficient information. As we learned in International Accounting Standard 36, except few transactions, normally there has to be an indicator for impairment test. Likewise, old approach was that there should be an indication that only then you will trigger, only then you will carry out the impairment test. And based on the incurred credit losses model, mean there must be an evidence that there is a loss incurred. So this was the old approach. What is the new approach? New approach is basically forward-looking, expected credit losses model, and no need for trigger event. See, the new approach eliminates the need for a trigger event to recognize impairment losses. An entity will make an ongoing assessment of expected credit losses, which will be updated and movements will be recognized at each reporting date. This will result in impairment losses being recognized earlier than under the International Accounting Standard 39 incurred loss model. The important thing is, in this model, in this new model, losses will be recognized earlier than the old model. Okay. What is the rule under new model? The rule is an entity shall recognize a loss allowance for expected credit losses on financial assets at amortized cost, financial assets at fair value through other comprehensive income, meeting both contractual cash flow test and the business model test, lease receivables, contract assets, and the example for this is debt securities, receivables, loans, loan commitments, and financial guarantees. So entity shall recognize a loss allowance for expected credit losses. What you expect, in fact, it has not incurred yet, but you expect that this much loss may incur in the future. So you are required to recognize that loss now. Now, what are the approaches in this regard? See, expected credit loss model. Expected credit losses are defined as expected shortfall in contractual cash flows. The estimation of expected credit losses should consider past events, current conditions, and reasonable and supportable forecasts. So what are the approaches for the calculation of expected losses? There are two approaches basically. One is general approach, or we can name it as 3 stages approach, and other is simplified approach, no stage. See, the new approach eliminates the as we discussed, the need for trigger. There is no need for trigger. You need to continuously reassess whether there are any expectation for the future losses. So thereafter, how can you do that? You can do that by applying these two approaches, general approach and simplified approach. What is the general approach? See, the general approach involves 3 stages. At initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flow it expects to receive. If credit risk of the financial asset is assessed to have increased significantly, then since the initial recognition, it enters into stage 2 of the model. If the credit risk of a financial asset increases further to a point where it is considered to be a credit impaired, it falls into stage 3 of the model, when you have an objective evidence of its impairment. And when it will enter into stage 2, when there is a significant deterioration in the credit risk. But on initial recognition, all assets where you are applying general approach will fall under stage 1. And subsequently, if there is an objective evidence, then simply this will be ranked under stage 3, or otherwise, if there is a significant credit risk deterioration, then it will fall under stage 2. Okay, in stage 1, at initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flows it expects to receive. If at initial recognition the cash flow it expects to receive are less than those in the contractual terms, 12-month expected credit losses are recognized immediately in the profit or loss and deducted from the carrying amount of the financial instrument by way of a loss allowance account in the statement of financial position. Then at each reporting date, the financial assets credit risk will be assessed. If there is no significant increase in credit risk since the initial recognition, or the financial asset is deemed to be low credit risk, it remains in stage 1 of the model. 12 months expected credit losses shall be recognized at the reporting date. So this is stage 1. Then stage 2. See, in stage 2, if the credit risk of the financial asset is assessed to have increased significantly, that is increased risk of default since initial recognition, it enters stage 2 of the model. This model recognizes full lifetime expected credit losses, that is an expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. There are the weighted average credit losses with the respective probabilities of default as the weights. There is a rebuttable presumption that the credit risk on a financial asset has increased significantly since the initial recognition when contractual payments are more than 30 days past due. However, an entity cannot solely rely on the past due information and should also assess the reasonable forward-looking information, as in stage 1, the movement in expected credit losses is recognized in the profit or loss and through the loss allowance account in the statement of financial position. However, if at the reporting date the credit risk has not significantly increased, the instrument will remain in stage 1 of the model. Then is basically stage 3. See, if the credit risk of a financial asset increases further to a point where it is considered to be credit impaired, it falls into stage 3 of the model, as objective evidence of the impairment exists at the reporting date. If these financial assets full time, then you will have to recognize the lifetime expected credit losses, as we can see in case of stage 2. Now, the next important point is, how can we calculate expected credit losses? How can we calculate the expected credit losses? See, the lifetime, if we just first of all discuss about the lifetime expected credit losses, an expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. So this is basically the present value of the credit losses that arise if the borrower defaults on their obligation throughout the life of a financial instrument. For example, the bail company has a portfolio of 50,000 financial assets, debt instrument that have 2 years to maturity and are correctly accounted for at amortized cost. Each asset has a coupon rate of 10% as well as an effective rate of 10%. No previous impairment loss has been recognized. At the year-end information has emerged that the sector in which the borrowers operate is experiencing a tough economic conditions. It is now felt that a proportion of loans will default over the remaining loan period. After considering a range of possible outcomes, the overall rate of return from the portfolio is expected to be approximately 6% per annum for each of the next 2 years. Calculate the expected credit losses on the lifetime basis. See, what we expect here, we only expect that 6% per annum will be received. Like, this is the expectation. After considering a range of possible outcomes, the overall rate of return from the portfolio is expected to be approximately 6% per annum, but in fact, it was 10%. Calculate the expected credit losses on a lifetime basis. See, this is the basically contractual cash flow shortfall. Because if we just go back to earlier slide, we can see that 50,000 is the value of this debt instrument, and the return was 10%. This means 5,000 was the return, and now we expect only 6,000 instead of 10%. So this means now the return will be 3,000 instead of 5,000. So what is the shortfall? Shortfall is 2,000. Shortfall is basically what you expect. What you expect, like this. 5,000 was the expected return, and this is now, this was the original return, and this is the expected return, which is 3,000. And this is basically the shortfall in the return. This is the shortfall in the return. So this is the shortfall in the return, 3.471. So this is basically lifetime shortfall on a lifetime basis. So what we concluded over here, that this is the amount which will be reduced from the carrying value of your financial asset. As A Limited has classified this liability at okay, so this is the amount which and you will be reducing the carrying value of your asset with this amount. So this way you can calculate the lifetime expected losses. Okay, now the next concept is 12 months expected credit losses. 12 months expected credit losses here, an entity calculates 12 months expected credit losses by multiplying the probability of a default occurring in the next 12 months by the total lifetime expected credit losses that would result from that default. So this is 12 months expected credit losses. Like there is a small illustration. Entity A originates a 10-year amortizing loan for 1 million. Entity A estimates the loan at initial recognition has a probability of default of 0.5% over the next 12 months. That is 99.5% probability that there is no default. At the reporting date, entity A determines that there was no significant increase in credit risk since initial recognition. Entity A determines that 25% of the gross carrying amount will be lost if the loan defaults. Required, calculate the expected credit losses on a 12-month basis. So I have included the answer in these slides, so we can see the answer. So this way you can calculate at the reporting date the loss allowance for the 12 months expected credit losses 1,250. 1,250. And this is calculated by multiplying 0.5% into 25% into 1 million. As we can see from last slide, that 1 million is the carrying value of this loan, and probability of default is 0.5%. And as a result of this default, 25% expected to be lost. So when we multiply all these figures, this will give us the 12 months expected credit losses. So this is a way you can make your calculation. Now, the calculation of effective interest rate. In stage 1, on gross carrying amount. And similarly, in stage 2, you will be calculating effective interest rate on gross carrying amount. But in case of stage 3, on a net basis, that is after deducting expected credit losses from their carrying amount. See, interest revenue shall be calculated on the carrying amount of the financial asset. This will depend on the stage of the impairment model. applicable to the financial asset. Interest revenue is calculated by applying the effective interest rate to either the gross carrying amount, stages 1 and 2, or the net carrying amount, that is gross carrying amount less any impairment loss, stage 3. Okay, now the simplified approach. Simplified approach, simply lifetime expected credit losses. See, if the credit risk of the financial asset is assessed and you want to apply this simplified approach, then you will be recognizing lifetime expected credit losses. So this is our general approach. You will be applying this general approach. This slide is very important from a practical point of view. Like this general approach will be applicable to these assets, except trade receivable or contract assets under IFRS 15 without significant financing company. Except these, you will be applying general approach for all financial assets. And simplified approach will be applicable to trade receivables, contract asset. You can see that this approach is not applicable to these two. And then lease receivable, you can mention over here IFRS 16. If chosen to measure loss allowance at lifetime expected credit loss. See, for trade receivable that do not have an IFRS 15 financing element, the loss allowance is measured at the lifetime expected credit losses from initial recognition. For other trade receivable and for lease receivable, the entity can choose as a separate accounting policy for trade receivable and for lease receivables to apply the 3-stage approach or to recognize an allowance for lifetime expected credit losses from initial recognition. So here you have an option. This is a policy matter. I will repeat it again. See, for those trade receivable that do not have an IFRS 15 financing element, the loss allowance is measured at the lifetime expected credit losses from initial recognition. Mean you will be applying for those trade receivable the simplified approach. But for other trade receivable, what are the other trade receivables? Those trade receivables which have significant financing company. Their entity can choose. Their entity has the option whether to go for the general approach, mean 3-stage approach, or whether they want to go for the simplified approach. And the same is the case in case of lease receivable. Entity has the option. Entity has the option either to go for the general approach or entity can opt for the simplified approach. Under simplified approach, entity recognize an allowance for the lifetime expected credit losses from initial recognition. Okay, before moving to the next area, if you have any question, you can type it now, and otherwise we can move it to the next area. The next is basically what is the difference between International Accounting Standard 39 and IFRS 9. We are going to discuss this difference. Of course, thereafter we shall be discussing hedge accounting. The difference is actually in IFRS 9, we are moving from a model where previously you had 4 classifications of your assets being loans and receivables, fair value through profit or loss, held to maturity, and available for sale. Under the new model, you are effectively going to have 3 categories, and they are going to be determined in line with your business model that you employ, as opposed to under International Accounting Standard 39, where the rules are more prescriptive as to what goes where. So under IFRS 9, if your business model is fundamentally to earn money and collect those contractual cash flows you will be using an amortized cost. Whereas if you are, for example, trading asset, you will have to apply the fair value model. There are a number of ways that you will utilize third category, which is the fair value through other comprehensive income, and that will depend on, again, the business model. So for example, where you hold asset with both the intention to collect the contractual cash flows, but you also focus on how to collect the cash flow first, but also to sell them as well. Then this will be your classification. Means, in simple words, if your model is such, like you hold them for contractual cash flows as well as you sell them as well, if whenever you find an opportunity, whenever you find a beneficial opportunity, there you do not have any option. Under IFRS 9, you will have to go for fair value through other comprehensive income. Okay, so there are a number of other differences on the asset side. Probably the most significant that has not been mentioned so far is the removal of the embedded derivative concept on the asset side. Okay, what are the key implementation challenges? The key implementation challenges, number one, is the key constraints. Resource constraints. A lot of resources are required to implement this new IFRS 9 standard. Coordinating multidisciplinary efforts across IT, finance, and the risk. A lot of people are involved. See, when we talk about incurred credit loss model, so that is very easy because there will be an evidence of the impairment. Evidence is there. Based on that evidence, loss is already incurred. You are recognizing an impairment. The things are simple. But now you will have to foresee. You will have to look into the future about the expectation of the credit losses. Or if you are applying general approach, right at the initial recognition, your asset is in stage 1. This means at least 12 months expected credit losses will have to be incorporated in the value of your asset, in the value of your asset, in the form of loss allowance for losses, allowance for credit losses, and then subsequently you have to be vigilant about its deterioration in the credit risk. If there is objective evidence about the deterioration, then your asset will fall under stage 3. This means you will have to recognize lifetime expected credit losses. Mean what you expect over the life of this asset, you will have to recognize the whole amount now. So likewise, in case of stage 2, if your credit risk deteriorated significantly, then your asset will fall under stage 2. The same treatment as we have seen under stage 3, except in case of stage 3, the difference is recognition of the interest revenue. In stage 1 and 2, you will be recognizing your interest revenue on a gross basis. Whereas in stage 3, you will be recognizing your interest revenue on a net basis after deducting any impairment losses. So you will have to develop models. You will have to train your people. You will have to realize board of directors that now the requirements are changed. They have to be more vigilant. They have to adopt more sophisticated model in order to predict the expected credit losses. So, but the most serious thing is for banks and financial institutions, because according to a survey, where they have surveyed 54 global IFRS reporting banks, 18 of which are globally significant important, and quantitatively more than half of the banks, those were surveyed, and that the expected loss approach will result in their provisions increasing by up to 50% across all non-asset classes. So quite a big change. I mean, right now, if you sorry, if you under International Accounting Standard 39, if you expect to recognize a provision of like say 50 million, so this will go up by 50%. So this means you will have to recognize 75 million instead of 50 million under ISA 39. When you are going to apply IFRS 9, you will have to recognize 75 million. So this is a huge amount which is going to hit your profit in the first year of the adoption of the IFRS 9. So this will definitely affect, this will send a negative wave to the stock market, because your profit will especially for the bank and the financial institution, their profits are going to hit very badly. So on readiness, see, if we look at the readiness, there is a good level of knowledge beneath the board. But I think that with all of the other pressures on bank boards from regulators and events, there is still a surprising lack of knowledge at the board level. But this is changing. I mean, of course, now bankers are concerned, because this is to greater extent is an issue of the top level management, that how they will be adopting this new impairment model, and how they will be justifying, and how like their system will adopt to this new approach. They will have to change IT. Of course, this may affect their deferred tax calculations. Of course, this will affect their risk management patterns, and of course, this will bring new additional disclosures as well under IFRS 7. So we have not yet covered the hedging. We shall be covering the hedging, but before that, I would like to. Okay, we can start, I think, hedging. So we have some time, so we can start hedging, and that will, of course, continue till tomorrow, and then thereafter we shall be discussing IFRS 7. And I suppose because I was receiving requests for IFRS 13 as well, if we have some time tomorrow, then we will add IFRS 13 as well, because fair value measurement, if it is not specifically mentioned in any particular standard, then you will have to apply IFRS 13. And a lot of standards require the determination of fair value. So that standard is important. If we could save some time from tomorrow session, then I will try to discuss with you IFRS 13 as well. Okay. Now we move to hedging. Okay, should I give you the hedging material for posting over there?
Yes.
You have given it to me. Okay. So we can have a 2-3 minutes break. Meanwhile, if you have any question, you can write that question.
Material is available in folder 2, day 2 material.
Okay, hedging. Hedging is basically under hedging, we shall discuss fair value hedge, cash flow hedge, and hedge of a net investment in a foreign operation. See, we all know that what is hedging. Hedging is in fact, hedge means to protect yourself. Like if you sold goods to an American customer, and you will be receiving like $1 million in 2 months' time or 3 months' time, and you are afraid that due to change in the exchange rates, those dollars may convert into a lower amount of local currency than the amount which you can get now. So this is the risk of loss, and you want to protect yourself. You want to cover yourself from this loss. So that's why you apply hedging techniques, so that you could avoid this loss due to exchange rate movements. Similarly, there could be a situation like you have a loan at a fixed rate, but you are afraid that maybe in the future the interest rate falls down, and those future interest rate may be below your fixed interest rate, in which case, in fact, you are paying interest at a higher rate than the prevailing interest rate in the market. So you want to protect yourself. You want to hedge yourself from this loss of paying higher interest amount. And similarly, there could be a situation you are holding an asset, you are holding an inventory, which will be sold sometime in the future, and you are afraid that its value may not fall, causing loss to your business. So you may hedge the value of that inventory. And similarly, you might have firm commitments of buying some asset, and you already committed the amount which you will pay at that future date. So there is a risk that due to changes in the value of those assets, you may incur a loss. You may be paying a higher amount than you should under the current conditions. So normally a businessman is worried about these losses. Like if you are a manufacturer of biscuit, if you are a biscuit manufacturer, and your say basic raw material is wheat, and you are afraid that when you actually need the wheat prices may go up, resulting in higher manufacturing cost, which will reduce your profit margin. So you want to hedge yourself, you want to protect yourself against this unlikely movement of prices, unlikely movement of prices of wheat. So that's why you apply different hedging techniques. But our discussion is based basically on two things. Number one, we may need hedging techniques for various types of transactions. So where that hedge will be classified as a fair value hedge, and where that hedge will be classified as a cash flow hedge, these are the two things which we will try to learn through the session on hedging. This is number one. Number two, once we decided, okay, this is a fair value hedge, or we decided this is a cash flow hedge, what is the accounting treatment for the fair value hedge? And similarly, what is the accounting treatment for the cash flow hedge? So first of all, we go for the go for our first learning objective. First learning objective. Like, how can we decide what are the principles, what are the methodologies which can be applied to determine the type of hedge? And the type of hedge depends on the risk being hedged. This is very important. This is the key point. Type of hedge depends on the risk being hedged. For example, if we just discuss about fair value hedge, what is this fair value hedge? A hedge of the exposure to changes in fair value of a recognized asset or a liability, or an unrecognized firm commitment or a component of any such item that is attributable to a particular risk and could affect profit or loss. See, when you want to hedge something which is fixed, this is your cash flow as a fair value hedge.
We have 2 or 3 questions.
Yes, please.
Zunaid Gerard asking, hedging and derivative contracts are more close to gambling. If we look into the substance over form, that it give rise to winner or loser situation. What will be your opinion? What will you say on this? Why it is not illegal in countries prohibiting gambling?
Who is this gentleman?
Zunair.
Zunair, you are very right. Of course, there are 2 types of people, but majority of them using it for gambling to make short-term profits. But there are people who are using it to hedge themselves against various types of losses. As I mentioned, manufacture of different products, and similarly like exporters, importers, like who have to pay in foreign currency, or who have to receive money in foreign currency. They are generally facing different types of risk. So they use these techniques to protect themselves. But majority, you are very right, majority people use it for gambling purpose. But gambling is a little negative for short term trading. In fact, their purpose is not to hedge themselves. In fact, they want to get benefit from the movement in the prices. Like if we take the example of the currency market, you will be surprised to know that the changes in the changes in the currency prices, currency rates, is 90% due to speculation. Only 10% is because of the genuine demand of the currency. So the same is the case with this derivative market. Okay, you want to say something?
I want to say that I think in current scenario, the hedging is more relevant to us because we have some exchange rate parity over dollar and rupee difference. So I think the hedging could have an effective.
Then you are very right. You are very right. Even it is not hedging is something which is a normal practice which you when you face any risk. It is not only the currency. Even if you are a manufacturer, so it is not a matter of currency. It is a matter of buying a commodity, like after a couple of months, after a few months, and you are worried that you may not incur loss as a result of change in prices, so you can hedge your position. Other question?
Puramesh is asking you, we will be having hedge slides.
Definitely, Khurram. You will be having hedge slide, definitely. But for now, I would request that like whatever important concept I discussed, please keep on noting that. Of course, all these slides will be sent to you people.
Aslan Rashid saying, where can we download the health presentation? It is not available in the handout.
No, after 20-25 minutes, I'll be handing it over to my ACC team. So they will be uploading it on GoToWebinar. I suppose you people can upload it on Google Doc as well. Is it possible today that you will be able to do that as well? Khyam?
Yes.
Will it be possible for you? Okay.
Yes.
Yes. Next question. Okay. Okay, we were discussing fair value hedge. So when you require a fair value hedge, something you can learn from this definition, like you can see that asset is already there on your balance sheet, liability is already there on your balance sheet. You already have a commitment. You already have a commitment, something which is fixed. Asset is there, liability is there. When you want to hedge, which is something fixed, so that is your fair value hedge. For example, you issued some bonds with coupon 2% per annum. You issued some bonds with coupon 2% per annum. It's nice, you always know how much you will pay in the future. It's good. Like you know for sure that you will be paying at the rate of 2% per annum. But you are worried that in the future market interest rate will be much lower than 2%. And you will be overpaying. In other words, you could get the loan at much lower interest in the future than you will be paying at the fixed rate of 2%. So this 2% fixed rate, you want to hedge it, and you enter into interest rate swap to receive 2% fixed and pay, say, LIBOR 12 months plus 0.5%. This is a fair value hedge. You tied the fair value of your interest payment to the market rates. See, the important thing is when you want to hedge a fixed rate for floating, this is your fair value hedge. Another example is inventory. See, in inventory, an exposure to fall in the fair value of inventory. You have inventory. You are holding inventory. This is in your stock. So you are afraid that its price will go down. So that's why you enter into a hedge, and that hedge will be termed as fair value hedge. And similarly, fixed rate debt. An exposure to changes in fair value due to changes in market interest rate. As I explained, with the help of like a small example of a loan, of a bond where 2% per annum is the interest rate, fixed rate. So because this is fixed, so this is fair value hedge. Asset with a current fair value of 200 million. It is concerned that the asset will fall in value, and an unrecognized firm commitment. So the fair value may change. These are the examples of the where you enter into a fair value hedge. See, so if you are receiving fixed and paying at a float rate, so this is your fair value hedge. Okay. No. What is the accounting for fair value hedge? The accounting for fair value hedge is, we can discuss this with the help of this small illustration. Okay, you read this illustration. We can have a small break meanwhile. before discussing this illustration.
In the meantime, they will be sending their questions, I think.
No, I suppose once we will discuss the accounting treatment, only then they might have any question on that. Okay, let's refresh ourselves with a couple of pop-up questions related to the material which we discussed from 4 o'clock. So please wake up for pop-up question. The pop-up question is, Mr. Haroon, I would request, please write.
Just a second.
Okay.
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 You get there. Financial instruments. All questions.
The old impairment model is based on incurred credit losses. This is the main statement. The old impairment loss model is
Impairment model is based on
incurred credit losses. Yes or no? Yes or no? You can pop up this question. Give me writing pad, yeah? So that I can write. And finance. Can you please pop up this question?
still on the screen now.
मेरे हम नहीं जागी जा रहे पता नहीं क्या है चलिए
How much time do they have?
1 minute.
1 minute. 30 seconds, 30 more seconds to go.
Okay, so we have only a few seconds left now. I'm going to close this poll. So you have to submit your answers right away. I'm going to close it now. Okay. Hands up. So we have 76% people saying yes,
Okay.
while 24% people saying no.
76% people are correct, but the rest of the 24% should also be like they should be careful, because this was a very straightforward question. Impairment, old impairment lot impairment model is based on incurred credit losses. And the next pop-up question is coming now. Should I make you write that question?
Yes,
See,
this one?
yes.
Yes, I am going to
No,
write.
but I need to complete that as well. What is there?
If a financial
Yes, if a
asset
financial asset,
satisfies
if a financial asset satisfies
business model
business
and
model and cash flow tests, then
then
it will be
it will be
accounted for using fair value through profit or loss, FV, fair value through profit or loss. Yes or no? Options are yes or no.
Yes. Okay, so I'm going to pop it up. So all the attendees wake up now. As you can see the poll question on your screens.
Give them 1.5 minutes, because this is a little difficult.
Okay, I will give them about 1.5 minutes.
Let me write another question.
Only 45 seconds left now. We have so far 13% people who have voted for this poll question. Please wake up and please participate. Although I can see many attendees who are throughout the session, like they will be reported as non-attentive from GoToWebinar. I think they must come up and participate so that we will be having some kind of interaction with you to know that you guys are listening and getting benefit out of it. Only 5 seconds left now. I'm going to close this poll in a bit. Okay, I'm going to close. Please submit your answer. Thank you, everyone. So we have 63% people saying yes and 37% people saying no.
37% people are correct. Because when these two tests are satisfied, then you will measure your asset using amortized cost, not fair value through profit and loss. So minority is correct. So always the answer is not yes. So these are the small concept, but very important concept which should be very clear to us. Now another pop-up question. Another pop-up question is basically related to trade receivable. Let me explain before popping up that question.
Okay.
Trade receivable is a financial asset and that is a debt asset. Because that is a trade payable for another entity. So question is related to this because I very clearly tried to convey you its initial recognition.
Sir, in the meantime, we have received feedback from our attentive attendee named as Madhiya Suel. She is saying, sir, pop-ups are very useful and helpful so that things are more clear. These should be more in number.
Madhiya, inshallah, I will take care of that. But Madhiya, I was basically expecting a lot of questions as we received last year around 800 to 900 questions on this topic. So that's why I was holding pop-up question just to answer your specific queries. So when I realized that perhaps you people are very well conversant on this topic, so I decided let me check that as well. So anyway, I'll make sure that in the future sessions I should use pop-up question more frequently. Okay, can you please pop up this question, Khayam? Can you please pop up this question? No.
Only 30 seconds left now. So far, 1 minute have gone. 18%.
Let them think on that.
Okay. But we have majority percent people saying. So minutes left for our session. So do you want me to close now?
Yes, sure.
Yeah, I'm going to close this poll question now. Please submit your answers right away, if anybody left. Okay, so I'm going to close. Thank you, everyone. We have 79% people saying yes, while 21% people saying no.
79% are correct. 79% are correct. See, we learned that the financial asset should be initially measured at fair value. But there are two exceptions. One is trade receivable is a financial asset, but initially this will be measured in accordance with the criteria given in IFRS 15. So this was one exception. So another exception is like if part of the consideration given for a financial asset is something other than the financial asset. In that case, the financial asset is initially measured at fair value, evidenced by a quoted price in an active market for an identical asset, or are based on a valuation technique that uses or data from observable markets, and the difference between the fair value at initial recognition and the transaction price is recognized as gain or loss. Otherwise, the consideration given is will be treated as a fair value. Now we shall be popping up our last feedback question. So, Mr. Khayyam, can you please pop up last feedback question? Thank you very much for
your
your
questions. So I'm going to pop up the feedback question now. It's on this screen now. I hope they will see and they can participate.
Can you please ask someone to? What did you say? 8%.
So I think I should close this poll right now. Okay, I have closed the poll. So we have 42% people saying excellent, while 45% people saying very useful, 12% people saying good, and 1% I don't know from which area are saying.
So I would request that 1% please send your suggestion for improvement or where you need more clarification.
We have some very valuable comments from our valued members and attendees. Just a suggestion, if we can have these CPD sessions on Fridays and Saturday, Asim Masood, we have already sessions on Fridays as well, but Saturdays are off right now at ACCA. In the meantime, Sanaullah saying very valuable session.
Thank you, Sanaullah.
And Muhammad Hassan saying mistakenly clicked on unacceptable. It is very useful session, and ACCA should keep on organizing such sessions.
Okay,
thank you, Muhammad
Much.
Hassan.
Thank you.
I'm going to
really you relieved us. Otherwise, we were thinking, what should we do? Anyway, thank you very much.
And I'm going to pop up the last question that is about their current residing country from where they are heading to ACCA
and please yes, and please accept my sincere thanks for your valuable feedback, and I hope we will continue this interaction with each other. And thank you very much for your compliments.
Saying great job, sir. Sanaullah saying stay blessed.
Sanaullah, thank you.
Khurram Rashid, excellent course. and Arslan Rashid. It is very useful and informative.
Thank you very much. Thank you. Bye from my side.
I think from that 1% mistakenly, some people have picked up and saying so many valuable comments to us.
Thank you. Thank you very much. Even that 1% corrected himself, and thank you very much for him as well. Anyway, thank you.
I'm going to close this poll as well, and the statistics will be on your screen now. We have this time more participants from Pakistan. They are about 47%, and from Middle East we have 41%. Sri Lanka 2% and Bangladesh 6%, while others are from, I think, Oman, Qatar, and such other countries. I don't know from where they are, but they can write to us in the question box or chat box. Ramahan, wow, so Middle East more. Middle East is more, yeah. Definitely around our previous sessions, they are greater in numbers, but this time Pakistan won this situation. Thank you, everyone. I hope you guys have benefited from this session. We have one more session left now on financial instruments, and that will be on the same topic and will be broadcasting on the same time tomorrow. So have a nice evening, everyone. Take care. Goodbye. Allah Hafiz. Fi aman Allah.